Markets now green after this morning's CPI report. You got to take a look at this on the Wi-Fi Interactive. These are the futures, S&P 500 futures, now up over 1.75%. I want to show you what happened at 8:30 a.m. Got this huge drop here, but now we are higher than we were just before the report. And if we take a look at the year-to-date action on the S&P 500, this is pretty significant here. When you're going up on a bad news day, that is potentially bullish. We got a firm rejection of these lows here around, what is that, 3,600 or 3,500, and so we're going to have to see if this continues. But I want to show you a very similar market, just in terms of price reaction. Here we have Bitcoin. Now, we did get this big downdraft at 8:30 a.m., followed by another one a bit later, and now we are heading higher. But you can see Bitcoin not reclaiming all of those losses. But we want to stick with this, the crypto market, and joining us now to discuss how is Hugh Roberts, Quant Insight Head of Analytics. And we want to get your take on what's going on with Bitcoin this morning, and because it's had an incredible correlation with stocks, particularly the tech sector.
Absolutely. Actually, you've just taken my punchline away from me. So what Quant Insight does, just to back up a second and to give some context, is we look at macro factors, so growth, inflation, measures of financial conditions like real yield, slope of the yield curve, what the Fed's up to, and measures of risk appetite. And then we look at all different assets across equity markets, bond markets, commodities, FX, and more recently in the last few years, crypto as well, and give a sense of the macro characteristics of that asset and whether that asset is rich or cheap to prevailing macro conditions. For a long time, for the first couple of months of this year, crypto was not trading as a macro play. It was trading off crypto technicals. But in April, it came into a new macro regime. And to your line, it is trading very much, the characteristics of it are exactly the same as a US tech stock. The difference being, whereas S&P, NASDAQ have all been cheap on our models, beaten up in the last couple of weeks, crypto has looked expensive. So in a way, we've been kind of waiting for this price action. The valuation gap is not extreme, but both Bitcoin and Ethereum, they both look modestly richer on our models, and macro fair value has rolled over while the spot price has kind of been holding in there. So we've been waiting for price action like this.
Let me ask you something, because Bitcoin is knocking to the downside on the lows of the year, which also coincidentally happened to be the highs, roughly speaking, of that huge bull market in 2017, many years ago. Just wondering what you think in the price action happens should that floor, temporary floor, maybe be breached here. 18,000, what's the next level?
Yeah, absolutely. Well, I would defer to chartists and technical analysts who will know that better than I would. But yeah, Charting 101 tells you that if we take out those levels, then clearly it doesn't look good. And the crypto winter, which I think people hoped was beginning to kind of maybe form a base and could potentially be looking to reverse higher, this would suggest that actually that the bear market was just pausing for breath and the charts would point to significant downside. Mm-hmm. But that's very much a technical analyst perspective. As I say, we come exclusively from a quantitative macro perspective. Well,
let me extend that then to the general currency markets, where we've been describing, I've been talking about this almost the whole show, the incredible strength of the US dollar that we've seen here. What is your quant analysis at the macro level show you in terms of the pain that the US dollar rise this year is having on other currencies, especially big ones like the yen and also the pound at a record low versus the dollar?
Yeah, absolutely. I think that's a very fair comment. And I think you are seeing that the stress and strains of the current global monetary policy tightening cycle is actually manifesting itself first and foremost in overseas markets. The strength of the dollar, it caused that 20 billion unilateral intervention from the Japanese and dollar yen a few weeks back. We've all seen eruptions in sterling and gilt markets. Now, some of those have their own idiosyncratic flavors in the case of the UK and the mini budget, but you can say that the reason we got here in the first place has been the strength of the dollar for the first 9 months plus of 2022. The interesting thing from our modeling perspective, to go back to your question, is that for the first 5-6 months of the year, all the major FX crosses were very much macro plays. It was interest rate differentials. Sometimes it was nominal rate differentials. Sometimes a different cross might feed more off real yield differentials. But it was very much about a hawkish Fed kind of outstripping its central bank peers. But a few months back, our model confidence, which just captures how good a job macro is doing in terms of explaining price action in FX, started to fall and fall aggressively. So the interpretation from our side is actually the last couple of months in the dollar rally has been less to do with fundamentals and actually more to do with non-macro factors. And I suspect key amongst those has probably actually been trend and momentum, and it's CTA flow just spotting the one-way trend and pushing things higher more than it's been about macro.
No, if that's the case and it's all about momentum, I'd say we're in for a ride because these things tend to go parabolic before they reverse. Hugh Roberts, Quant Insight Head of Analytics, really appreciate your insights here.